You've heard the markets skyrocketing. Is it really too late to jump in? There's a lot of hype out there about whether or not it's too late to invest since the stock market has already gone up. People often feel excited when they see big market gains, but they also worry that it might be too late to join in and enjoy the profits. Let me set the stage for you so you'll understand exactly why we're having this conversation. We're dealing with a situation where you might look at the stock market charts and see steady climbs or even a big spike. Then you might think, wow, I missed the low price party. Now what? Welcome to the program You Can Surpass the Stock Market. Here I show you how you can reach the peak where few arrive in the stock market without getting overwhelmed. I am Francisco and I'm an expert in finding stocks that can top the S&P 500. Today's topic is crucial. The stock market is up. Is it too late to start? This question comes from the fear of missing out, often called FOMO. If you're someone who works long hours and has tried to top the S&P 500 but struggled, stick around. We'll break down the reasons it might feel too late and why it might not be too late at all. I'm here to talk with you step by step, giving you clarity and helping you avoid overwhelming amounts of information. Let's first unpack what people usually mean when they say the market is up. Is it too late? Picture this scenario. You've been watching from the sidelines for months, or maybe even years. You've seen headlines about record highs or unstoppable bull markets. Stocks keep climbing. Maybe your coworker boasted about how much money he's made. Perhaps your neighbor retired early, thanks to safe investments a few years back. Now the fear strikes. Have I missed my chance? I believe we should understand how markets move in cycles. We want to avoid big emotional mistakes, fear and greed. Fear says if I invest now, I might lose everything because it's too high. Greed says this market is unstoppable. Let me put everything in right away. A balanced approach causes us to look at factors, do a bit of reasoning, and invest wisely. That's part of what we'll do here. I'll explain the difference between it actually being too late and times when it's not too late. So, is it actually too late to start investing in a market that's already up? If we define too late as a situation where the market is overheated and about to crash, then yes, you can be in trouble if you drive in recklessly. But we have to remember that timing the market is extremely difficult. Plenty of brilliant people have tried to time the market tops and bottoms, and many have failed. The market can keep running higher than you'd expect, especially if the driving forces like consumer spending, technological innovations, or corporate earnings remain strong. On the flip side, many folks panic when the market's gone up a lot, assuming it must crash soon. Sometimes that crash doesn't come for years, and by waiting, they miss the continued gains. To give an example, after the 2009 recession, people who got in by 2010 or 2011 might have thought, I missed the bottom in 2009, I'm too late. But the markets climbed for many more years. Anyone who took a balanced long-term approach still experienced significant growth from that point onward. Now, if you ask me, when it is not too late, I'd say it's not too late anytime you're willing to do your homework or adopt a steady investing strategy. This might mean investing in quality companies with consistent earnings. Even if prices have risen, these companies can continue growing if the economy remains supportive. And why investing in a stock market that's already up can be an opportunity. To answer this question, we must first answer to the question, what is investing in a market that's already up? It means you're putting your money into stocks after a period of rising prices. It may feel like you've missed the cheap buy-in point. However, you're also avoiding the uncertainty of a bottom that might keep dropping. In a rising market, you have some evidence that investors overall see promise in the economy or certain sectors. If you're somebody who invests in the stock market but rarely has time to track every twist and turn, then you might be frustrated about missed opportunities. You see your portfolio underperforming the S&P 500. You wish you had more time to follow trends or had more advanced research to beat the market. By investing in a market that's already up, you might feel more confident that you're joining a wave of positivity and growth instead of trying to guess a bottom. This confidence can reduce your stress and the fear of catching a falling knife. The main benefit is momentum. Think of it like surfing. Once the wave forms, a surfer wants to catch it at just the right time to ride it to shore. If the wave is already forming, you can still hop on. You just need skill and timing and understanding of how the wave moves. When the broader market is on an upswing, many stocks benefit from that optimism. Of course, not every stock is a winner, which is why you still need some selectivity. But riding an established trend can often be easier than trying to guess the moment a downward trend will flip. Let's break down 3 examples that show how people invest in a market that's already up and still do well. Imagine that for several quarters, large tech companies have reported strong revenue, new innovations, and user growth. Their stock prices rise. Some folks might say, I missed the boat months ago. But if these companies are continuously beating expectations, they could rise further. By investing after they've already shown strong performance, you're not speculating blindly. You're basing your decision on actual results. Over the past 5 years, Costco's stock price has consistently outperformed the S&P 500, driven by its strong membership model, bulk bargains, and steady expansion both in the US and internationally. Some investors might see Costco's rising share price and think they've missed the boat. But if Costco continues to add new warehouses, maintain high member renewal rates, and offer appealing merchandise, it could keep growing. By investing in a proven retail leader like Costco, even after it's climbed, you're placing your money in a company that's shown reliable performance and has a record of beating the broader market. While no stock is ever guaranteed to rise indefinitely, Costco's focus on value, member loyalty, and global growth positions it has as a solid choice for long-term investors. Another strong performer beyond the tech sector is Lowe's. Over the past 5 years, Lowe's has regularly outpaced the S&P 500, fueled by steady demand for home improvement products, store upgrades, and successful e-commerce expansion. Alongside delivery market beating returns, Lowe's pays a solid dividend and has a track record of regularly increasing those payouts. While the share price has already climbed, if Lowe's continues to grow its online presence, optimize its stores, and benefit from ongoing home renovation trends, the stock could keep rewarding its shareholders. By investing in Lowe's, even after its notable run, you're aligning with a proven home improvement leader that has consistently beaten the broader market, offering both potential share price appreciation and a dependable stream of dividend income. Let's talk about 3 common worries people have when they see the market going up and wonder if it's wise to jump in now. Objection 1. Aren't we at the top? The market's going to crash soon. No one truly knows if we are at the top until after it happens. The market could keep climbing for much longer than you expect, or it could pull back sooner. History shows that trying to time the market precisely is extremely difficult. Instead of timing, focus on strong fundamentals, asset allocation, and consistent contributions. Even if the market does correct, if you're investing with a long-term horizon, you can ride out temporary drops. Objection 2. I missed the best opportunity. Should have invested a year ago. Hindsight is 20/20, as they say. Of course, it would have been nice to invest at least year's low or last decade's low. But remember, the next 10 year might look very different. And the best time to invest consistently is as early as possible. By the time you realize the market has risen, it might still be only pathway through a bigger trend. Don't miss out on future gains just because you regret missing part of the previous run. Objection 3. I can't handle the risk. What if I lose money? It's normal to worry about losing money in the stock market. But remember, there's also a risk to keeping your savings untouched. Over time, inflation can quietly chip away at its value. While you can't remove risk entirely, you can manage it through smart strategies like diversification, dollar cost averaging, and choosing well established companies or index funds. This way, you're spreading out your exposure rather than putting all your eggs in one basket. If you keep a balanced view, understanding both the potential upsides and the possible downsides, you can invest without letting fear of temporary losses hold you back from long term growth. When the stock market is on a hot streak, it's easy to get caught up in the excitement and believe that you simply can't lose. Headlines boost over record highs. Social media buzzes with the stories of people making quick fortunes, and conversations around the water cooler often revolve around the next big thing to invest in. Amid all this hype, it's tempting to think, why not jump in headfirst? However, while a rising market can indeed be profitable, it also comes with its own risks, especially if you approach it the wrong way. Below, you'll find 5 different wrong ways to invest in a stock market that's already up, along with an explanation of why each approach is so dangerous. By learning what not to do, you'll be better prepared to protect your money and pursue a more sustainable path to grow. One of the biggest mistakes you can make when the market is soaring is to pour all your cash into a single much hyped stock. The logic might sound straightforward at first. If everyone's talking about company X and its share price has doubled in the past year, why not go all in? The problem is that every stock, even the seemingly unbeatable ones, carries risks. Market enthusiasm can inflate stock prices far beyond their actual value, and you may not discover how overvalued they are until it's too late. Imagine picking a hot stock that's been all over the news. Your friend tells you it's a guaranteed winner because they've already made a tidy profit. Feeling you've missed out, you dump your entire savings into this one position. Things might go great for a few weeks if the enthusiasm continues, but all it takes is one piece of bad news, maybe disappointing earnings or a regulatory roadblock, and the stock's price could tumble sharply. With your entire nest egg in that single basket, you risk losing a large portion of your wealth in one painful hit. Worse yet, if the stock never recovers, you're left in a deep hole financially. Ultimately, no matter how promising a single company appears, betting everything on it when the market is already up is a high stakes gamble, not a sound investment strategy. A right way to approach a market that seems unstoppable is to diversify your investment capital instead of putting it all into one high-flying stock. By spreading your money across multiple companies, you reduce the risk that any single downturn will severely damage your portfolio. Before you invest, do your research, check the fundamentals, consider the company's revenue growth, and understand its competitive advantages. Instead of getting swept up by hype, focus on whether a stock's price aligns with its underlying value. If it doesn't, you may be paying a premium just because everyone else is jumping on board. Once you adopt a well thought out strategy, you also gain the peace of mind that comes from mitigating risk. When one stock faces unexpected bad news, it's less likely to devastate your entire position. The benefit of doing this right is long-term stability and potential growth through varying market conditions. While it may be less flashy than riding a single stock, to the moon, steady gains often outperform short-lived highs. By embracing diversification and vigilant research, you keep a balanced perspective, safeguarding your hard-earned money while still participating in the market's upside. Over time, this approach can build financial resilience. When optimism runs high, some investors become overly confident and decide to amplify their bets by using margin, borrowed money, or other forms of debt. The thinking goes, if this stock is going to keep climbing, I might as well borrow money so I can buy more shares and earn an even bigger profit. While it's true that using margin can magnify gains, it also magnifies losses. And that's especially scary when prices are already elevated. Consider a scenario where you invest $10,000 of your own money plus another $10,000 borrowed on margin. If your chosen stock or fund rises by 10%, you might celebrate a larger gain than you have with just your own cash. But if the market suddenly dips, say by 10% or 20%, your losses will mount twice as quickly. If the price drops too low, your brokerage could issue a margin call, forcing you to either deposit more money or sell your shares at a loss just to cover the debt. In a swiftly declining market, you might be forced to sell at precisely the worst moment. The emotional strain of seeing your leveraged investments plunge can be paralyzing, and the financial damage could take years to repair. Using debt to invest in an already inflated market is like trying to drive at top speed on a slick highway. One wrong turn and you could be in serious trouble. A more prudent way to invest when the market is already hot involves relying on your own capital or using leverage in a minimal, carefully controlled manner. Before considering any borrowed money, make sure you have a clear strategy. Ask yourself, what is my tolerance for losses? Can I handle a sudden market correction without being forced to sell at a bad time? If the answer is no, it's best to avoid margin and stick to cash investments. This approach keeps you in control and protects you from the emotional roller coaster of margin calls and sky-high debt. If you do decide to use leverage, set strict limits on how much you borrow and be prepared with extra funds to cushion any unexpected dips. The benefit of doing it right is that you can sleep better at night, knowing you won't be wiped out by a short-term correction. You still participate in the market's potential gains, but with safeguards in place to prevent devastating losses. Over the long term, a more disciplined approach often proves more profitable because you're not scrambling to cover debt when prices swing, instead of risking everything in a frantic race for bigger profits. You're building stability and sustainable growth for the future. The fear of missing out is a powerful force in a bull market. When you see neighbors bragging about their windfall from a certain stock, or your social media feed exploring with tales of overnight millionaires, it's natural to feel like you have to act now or be left behind. This emotional urge can lead you to hop from one trending stock to another without doing the necessary research. For instance, you might read an article about a retail chain that has perfected e-commerce and jump on board solely because you see others raving about it. Then, a week later, you switch gears to an electric vehicle manufacturer rumored to be the new Tesla, selling your previous holdings even if they haven't underperformed. This constant chase can lead to buying high and selling low, as you're always late to the party, buying when hype is at its peak and unloading when the frenzy starts to wane. It's the opposite of a thoughtful long-term approach. Not only can this scattershot method burn through your savings in record time, but it also leaves you stressed, unfocused, and prone to emotional swings. In an already up market, hype often outpaces reality, making research and patience more important than ever. Instead of trying to resist hype altogether, which can be tough, allocate a small fixed portion of your portfolio, say 5 to 10%, that you allow yourself to use for following buzzworthy stocks or trends. This way, you get the thrill of participation without jeopardizing your main financial goals. By clearly labeling this fund as your FOMO budget, you're given emotional permission to chase a hot idea, but only to a controlled extent. Meanwhile, keep the bulk of your portfolio anchored in a well-researched, diversified holdings that reflect your long-term plan. It also lets you follow social media hype without feeling like they're throwing your entire financial future into the ring. If a pick from your speculative fund takes off, great. You've made some bonus gains. But if it tanks, the rest of your portfolio remains unaffected. By balancing a small playground for hype with a disciplined core of stable investments, you can satisfy the urge to explore big stories without risking your whole financial well-being. Some investors in a rising market become fixated on predicting the perfect moment to invest or cash out. They watch charts, follow every analyst's forecast, and try to pinpoint the absolute top so they can sell for maximum profit. Alternatively, they hold off on investing, convinced they'll swoop in at the next mini dip before the market climbs higher. While timing can occasionally pay off, history and data show that consistently timing the market is incredibly difficult, if not impossible. Say you've been studying every indicator you can find: consumer sentiment, bond yields, corporate profits, searching for signs of a major correction. Because the market has soared for months, you feel a certain crash is imminent, so you stay out. Meanwhile, the market keeps pushing higher for another year, and you miss out on all those potential gains. Or just as likely, you could be fully invested and fail to sell before a sudden drop. Watching your portfolio shrink fast, trying to time the market, leads many people to buy high and sell low because human nature tends to follow euphoria rather than rational planning. The result is often frustration, regret, and inconsistent performance. In an already strong market, the best approach is usually discipline, steady investing rather than guesswork about tops and bottoms. One creative approach is the stair-stepping method. Instead of striving to pick the exact top or bottom, you set incremental thresholds to either buy or sell. For instance, imagine you place small investment amounts whenever the market dips 3%, 5 or 7%, instead of waiting for a single perfect moment. You also plan partial exits if certain market levels are reached or if a particular stock hits a predefined profit target. This way, you distribute both your buying and selling decisions over several points, reducing the risk of locking everything into one poorly timed. The beauty of this technique is that it harnesses a structured yet flexible framework. You still respond to market movements, but without the all or nothing mindset that often leads to regret. If prices continue rising, you've already got some skin in the game. If they start dropping, you only invest part of your cash at each level, preserving capital for future opportunities. By automating or systematically executing these trades, you limit emotional swings and avoid endless second guessing. The benefit of doing it the right way is smoother performance over time and less stress because you're no longer gambling on that elusive perfect moment. It fosters confidence. If the market's already soaring and you're worried about jumping in at the wrong time, consider a creative strategy called the opportunity radar. Instead of plunging into random stocks right away, you set up a watch list of potential winners, along with clear signals that tell you when it's time to buy. Here's how it works, step by step. First, pick a handful of companies or funds that genuinely interest you. These should be solid, well-researched options that you'd be happy to hold for the long term. The trick is you don't jump in immediately. You place them on a watch list that you'll monitor closely. Think of it like having a radar screen where strong companies appear as blips. While the market is hot, you simply wait and watch. Next, create specific triggers or buy signals for each stock on your list. These can be price-based, like if it drops 5% from its recent high, or fundamentals-based, like if the company's earnings beat expectations by at least 10%. You can also include broader market indicators, such as a shift in interest rates or changes in consumer sentiment. These triggers act as a logic check, ensuring you aren't simply buying out as FOMO. Instead, you're waiting for a condition that shows the opportunity is ripe. Set up alerts on your trading platform or through financial websites. If one of your triggers is met, such as the stock dipping to a certain price, you'll get an automatic notification. This step frees you from obsessively watching the market every day. Once the alert arrives, it's your signal to reconsider and possibly initiate a purchase. It's a plan that encourages you to stay calm and methodical, even in a high-flying market. The real magic of the opportunity radar approach lies in waiting for the right conditions rather than chasing every spike. This patience can be tough when your social media feed is buzzing with market highs. However, by staying disciplined and trusting your predetermined signals, you avoid buying at random peaks or selling based on panic. You've essentially put your rational thinking on autopilot, cutting down on emotional trades. Even when a trigger is met, you don't have to pour in all your capital. Consider entering in increments, maybe 20% of the amount you plan to invest. If the price continues to be favorable, you can add more. If not, you've only committed part of your money, leaving flexibility for other opportunities. The opportunity radar approach gives you the benefit of both readiness and restraint. You're ready for compelling scenarios, like a price dip or a strong earnings report. You're also practicing restraint by not buying simply because everyone else is. This method helps you sidestep emotional pitfalls, such as fear of missing out or panic selling, because every decision is tied to a defined logical trigger rather than your mood or market hype. Ultimately, this leads to more confident trading and investing, no matter how overheated or uncertain the market appears. By aligning your buys with genuine value or strategic advantage, you stand a better chance of long-term growth, and you safeguard against impulsive decisions that often backfire. Over time, you'll learn that discipline trumps rash moves, and your portfolio will thank you for it. In my experience, the biggest mistake people make is letting fear or regret paralyze them. They see the market up and either think it's going to crash tomorrow, or they believe they missed their chance. The truth is more nuanced. Markets move in cycles, yes, but there are almost always opportunities if you look for them carefully and maintain a disciplined strategy. Remember, the stock market can be your friend if you treat it with respect and a plan. If you don't have the time or expertise, using simplified strategies can help you stay aligned with overall market growth. If you don't have some time and interest, you can research individual stocks or sectors where the momentum is real and supported by fundamentals. If you found any of this helpful, please subscribe to my channel. By subscribing, you will stay updated on future videos where I'll show you tips and strategies to surpass the stock market. I'm here to help you learn how to invest more effectively with less stress and hopefully get you closer to that level of success you've always wanted in the market. Feel free to leave a comment below if there's a specific topic you'd like me to cover next. I want this to be a conversation, not just a lecture. Remember that knowledge is one of your most powerful tools in this journey, and I am committed to sharing what I've learned over the years. Thank you for watching, and I'll see you in the next video.